Return to the question of why should accountants care about the market value of the firm, or if we take the market value of the firm divided by the number of shares outstanding, we get the market price with the price of a company's stock. Why should we care? If you were an accounting and finance double major, you've already gone into that. But if you're just an accounting major, like I was as an undergrad, I didn't quite understand that connection between the financial statements, which I was always very interested in, and then this the world of stocks that I just felt I didn't quite understand. Well, the primary users of financial statements are investors. The secondary users are creditors, those who lend to the company and want to ensure that the company makes enough cash so that they can get their interest and repayment of principal. But financial statements are geared towards those investors. I've always looked at financial statements just because I'm just curious about how is that company performing? How did performance change over time? But most people are interested in the financial statements so that they can have an indication of how is that company going to perform in the future, and how should I invest my money based on this company's historic performance? Investors use the financial statements to help predict future performance. And stock price is determined by investors' expectations. And if you were just an accounting major as an undergraduate, then the only finance class you've ever taken was Finance 215, the Introduction to Financial Management, and that covered a lot. So this video is going to assume that you took that class a while ago, and what should an accountant who's about to be working full-time, if you're not already, know about that link between the stock prices and financial statements? Okay, so as you know, assets of the accounting equation, assets are equal to liabilities plus stockholders' equity. And what I want you to be thinking about the balance sheet as, the company needs these assets in order to run the business. And the other side of the accounting equation is, how are those assets being financed? And we talked about that quite a bit last week. Actually, in the last few weeks when we talked about solvency, and then we talked about how that the company's financing in debt versus equity, how that relationship can lead to future profitability. Well, think about assets as being a measure of the company's value. Assets are reported at book value: land, buildings, equipment, trademarks, copyrights, every asset that you can think of. We're reporting them typically at the amount that the company paid for them. And then, of course, with other than buildings, equipment, and intangible assets that can be amortized, we're depreciating them over time. So we're not just using the book value, but the net book value. So if we sold the building, we sold a copyright, of course we could get way more than is listed on the balance sheet, or perhaps way less, because we're not using fair values or market values to value our assets. Liabilities, the amounts that the company has to pay back, those are typically close to, if you had to sell off your liability, then it's typically close to the book values are typically close to market values. So if we think about liabilities are typically close to the market values, assets are not. So what does that leave with stockholders' equity if this is an equation here? So stockholders' equity is based on book values, not market values, right? Assets based on mostly historical costs. Liabilities are fine, but if the assets are mostly on historical cost, we're going to see stockholders' equity is going to be based mostly on historical cost. And that's the reason why stockholders' equity might differ dramatically from the market value of a company's equity. Remember, stockholders' equity is typically common stock plus additional paid-in capital, retained earnings, accumulated other comprehensive income, less treasury stock. And again, remember we covered this in a previous week. Stockholders' equity is also referred to as the book value of the company, or the book value of equity. Market value, again, on the other hand, is a number of shares of common stock times the stock price. And the stock price is just determined by the market. And so if we want to know what a company's stock price is, it's going to change each trading day. We can go out to Yahoo Finance or Google Finance and pull up some information like this. Typically, we want the closing price. And we can see the number of shares. So how much, when you want to determine what is the market value of a company, we take the stock price as of a certain time. And we need to get the number of common shares outstanding as of a certain time. And I clipped this information here from the very first page of a company's, this is Papa John's, I believe, their very first page of their 10K. They say as of February 17th, which is not actually the fiscal year end. That's the date that the financial statements were filed. On the date the company files their financials, it tells us how many shares of common stock were outstanding. So we multiply the number of shares outstanding by the closing price on that same day in order to get the market value of the company. Difference between the book value and the market value is really important. That's why I keep going through these terms. They're really important and they're also really easy to confuse. So hope I'm not beating this to death. Book value is based on stockholders' equity on the balance sheet, and it's based on primarily historical costs. Sometimes those are depreciated or amortized, but the focus is not on fair values. And this difference is going to cause a major difference between book value and market value of a company. Market value is also referred to as the market capitalization or simply the market cap of a company. Or when I say a company, really what I mean is the equity of a company. What's the difference between book value of a company and the book value of the equity? The liabilities. Market value of a company versus market value of equity. Remember, we're not counting for liabilities there. So market value, just as we said in the last slide, is equal to stock price times the number of common shares outstanding. And it's based on investors' determination or expectation of stock price. The question is the market price of a share of stock, is that the true price? What is the true price? Well, if we could ask a God, the all-knowing, somebody who has all the information, what should the market price be? We would call that the intrinsic value, the correct price if we had all the information, and of course nobody does. So we don't know for sure that the market price is a proper measure of the value of a company, but oftentimes as we go through our analysis, we're going to make the assumption that in many cases it is. Now, stock price valuation is almost always determined by, when you're looking at models, valuation models, almost always determined by the basic principle of finance. The present value of either a bond or a share of stock of any asset is equal to the discounted or present value of its future cash flows. And so throughout the semester of financial management you took as a sophomore or a junior, you were discounting back present value and future cash flows. Now we're not going to focus on that in this class. Why? Well, what are these future cash flows? We don't really know, and that's something that can't be done in 1 week. In accounting class, that's something that you really need a semester on, and that was the focus of corporate finance. But you should be somewhat familiar with the equations and then this time value of money that you see here. We don't need to use this for this class, but recall that you've covered this in the past, that the asset's value is equal to the present value of its future cash flows. But that's all we're going to mention about that. And we're going to move on to a more basic measure of valuation and looking at that connection between financial statements and some measures of stock price valuation. Before we get to that, just a slide here just to mention a few different ways to measure that firm value or equity value, the discounted dividend model. So the question becomes, when we look at these cash flows here, what are those cash flows? Are we going to use dividends? Are we going to use some measure of residual income or abnormal earnings? Are we going to use some measure of cash flows, operating cash flows, free cash flows? And again, we're not focusing on that here. We can't cover that in this week, and that's not the focus of our financial statement analysis class for Masters of Accounting students. Here are the 4 topics we're going to cover: relative valuation models, PE ratios, price to sales, price to cash flows, and price to book ratio. Our measures are all relative valuation models. We're going to compute price multiples of comparable companies. Just like when I went to buy my house, so what's the right amount to bid on a house? I don't know what the house's intrinsic value is. What is that determined by? So you look at similar houses on the block in the neighborhood, then you have to make adjustments for, is there anything else that's different or unique about this company that I need to adjust for? That's kind of what we're going to do here, except we're not worrying about those adjustments. So price multiples, ratios of a stock's market price to another measure of fundamental value per share. And so what is that other fundamental value? Let's compare market price to, well, let's look at stockholders' equity per share, or in other words, book value per share. Let's look at sales per share. And price multiples are often used to determine if a stock is undervalued, fairly valued, or overvalued based on its comparison to those same values of similar companies. These measures are widely used and they're easy to calculate. That's why we're looking at them here today. So we see Morningstar's valuation metrics for Coca-Cola. We see price to sales, price to earnings, price to cash flow, and price to book. These are the over time. These are the measures that we're going to look at one point in time, just for the most recent fiscal year end 2020. And we're going to compare. We're going to calculate Coca-Cola's in this video, and then compare it to some of the same measures to some of its comparable companies. There's some caveats to using market multiples. Market multiples is used to determine whether a company's current stock price is under or overvalued or fairly valued. So it assumes that the market price for, let's say, Coca-Cola may not be right. But when we're comparing the, let's say, price to earnings ratio to comparable companies, well, if we think that Coca-Cola's might not be right, why do we think that those other companies are correct, right? It's all market data. So if we're going to look at Coca-Cola's and let's say its price to earnings ratio is really high compared to three of its other competitors, we think the stock is overpriced. But why do we think that the stock is fairly priced for those other three competitors? However, we use it anyway. It's not our only metric, and after watching this video, do not make all of your investment decisions based on this. Let's just see how some others in the financial markets use this information. Okay, so let's start with the first two that are based on income statement information, PE ratio and price to sales ratio. Let's start with the PE ratio. The PE ratio is probably the most widely used multiple. I'm sure you've heard the term PE metric. It's very common, so you'll see it in a lot of news articles because people are somewhat familiar, a lot of investors are familiar with PE ratios, at least in some sort of a general ballpark range. PE ratio is stock price divided by earnings per share. And it tells us the number of times that stock price exceeds earnings per share, obviously. In other words, how much are investors willing to pay for the stock for each dollar of earnings per share? How much does a dollar of earnings per share cost to the investors, to the market? PE ratios are higher when investors expect the company to experience growth in future earnings. So let's just consider Coca-Cola, for example. If its PE ratio increases over time, what would that tell us? Well, either we think investors are paying too much, that $1 of earnings per share that costs $20 to buy $1 of earnings per share. It used to cost 15, now it costs 20. We might say, well, that price is way too high. It's still just $1 in earnings. Or it could mean investors think Coca-Cola has extreme growth. We're willing to pay for the dollar this period, or $20 for a dollar of earnings per share this period, because we expect that the company is going to bring in more cash in the future. When a company has a higher PE ratio than its comparable companies, so if we can find companies with similar expectations of growth, this may be an indication that the stock is overvalued. Comparable companies should be in the same industry and have similar growth expectations. That's easy to say, but how do we know if Coke and Pepsi have the same growth expectations? And then after Coke and Pepsi, what other very, very similar companies can you jump right to your minds? Dr. Pepper is mixed with Keurig, which has a slightly different business model. So it's really hard to find companies that are very, very good comparables. Just like when buying a house, looking at the price per square foot is not a perfect measure when companies on the inside look different per square foot. So we use this, but we know that it's just kind of a general rough measure of value. So the PE ratio we have here again, stock price divided by earnings per share. Let's revisit earnings per share, net income minus preferred dividends, divided by the number of common shares outstanding. So we have to make some decisions when we're actually going to use these metrics. Stock price on what day? Now, if you look in a finance textbook, it'll say stock price today. So really we see these measures really depend on our use of days. For our purposes, let's try to match the stock price to the date of the earnings per share. And we don't know exactly the stock price at the fiscal year ends because we don't, well, we know the stock price at the fiscal year ends, but we don't know those exact earnings per share because the audited 10K is not going to come out for another probably couple months after, at least a month after the fiscal year ends because a lot of work needs to be done. But just for simplicity, let's use stock price on the company's fiscal year ends, even though we don't know exactly what earnings per share are on that date. So earnings per share of which period? So we could look backwards and we can say the last year. We could look forwards and say our expectations or what analysts expect for the future year. Both are used in practice for simplicity and because I want you using those financial statements every single week. Let's use earnings per share from the most recent fiscal year ends. And remember that earnings per share number is shown on the income statement. We haven't really used it much so far this semester. And if you look at earnings per share, you'll see that the companies have both basic and diluted earnings per share. Which one are we going to use? Let's use basic earnings per share. And if you don't remember the difference from intermediate 2 when we spent maybe 2 classes going through about 1,000 rules related to earnings per share, let me give you just a high-level overview of the difference between basic and diluted earnings per share. So here we see Coca-Cola's income statement. We see basic earnings per share of $1.80 and diluted earnings per share of $1.79. Diluted earnings per share says, what's the worst case scenario for us common stockholders? The numerator is always going to be the same. It's just going to be your net income. In this case, it would be attributable to the common stockholders of the company. Net income, but then the denominator changes based on basic or diluted. Basic is what is that weighted average number of common shares outstanding? That's simple enough to calculate. Diluted said, well, in addition to those actual common stockholders, where there are prospective common stockholders that were outstanding for this year, all of the option holders, every time the company granted options, typically to its employees, those employees had the option to exercise those options and get more shares of the company's stock. So what would that do to earnings per share if those holders of the employee stock options exercise those options? That would make that denominator in the earnings per share calculation bigger, and it would reduce earnings per share. Now that didn't happen in the diluted metric. How do we know that? Because if those owners of the employee stock options actually converted, then that would be accounted for in the weighted average common stock number of shares that's shown in this basic earnings per share. But diluted says, what if? Okay, so those holders of employee stock options that can convert their option into additional shares of stock outstanding, that's one metric. One thing that can go wrong, we can say, for diluted earnings per share. Another thing that could dilute earnings per share is convertible securities, convertible debt, and convertible preferred stock. Those are two types of securities that a company can issue, and it is up to the buyer of those securities or the holder of the securities to determine, do I want to convert these at any point to common stock? So those haven't been converted. If they had been converted, they'd be accounted for already in our denominator used in the basic earnings per share or weighted average common shares outstanding. But diluted said, what if the worst case scenario happens that everyone who owns a security that can be converted into common stock does? What would that look like to us? And so we see here for Coke, it's not that big of a deal. But in our analysis, we're always just going to stick with the basic earnings per share because it's simplest and we're just spending 1 week going over this. Sometimes companies or sometimes analysts investors will use the forward PE ratio. They'll look at stock price today to compare to earnings expected for the future year, but we're just going to stick with our most recent earnings per share. Let's move on to the price to sales ratio. The sales ratio is stock price, same as before, divided by sales revenue on a per share basis or per share of common stock. So why use sales per share instead of earnings per share? Earnings can be negative. As I mentioned, I screened when I pulled my data set, and I said only return companies that have had positive income. We don't have to worry about that when we're using, if we were just looking at sales. Sales is always positive. Can't have negative sales unless all you had was some returns in an accounting period. And it ignores expenses, which can be considered another positive, another advantage, because expenses are based on, from the income statement, they're based on accrual accounting. So companies can use different methods of depreciation expense, which they can be the same economically, but just based on using that different accounting method can lead to very different net income and also management discretion. If you think about bad debts expense, management has to say, what do we think we're not going to collect of our accounts receivable, and just use their best estimate. And so management might use judgment to their favor to, let's say, minimize bad debts expense and maximize net income. So the caveat to this, well, it does ignore expenses and it's not looking at net income. So remember when we looked to analyze performance last week, we looked at how much income was produced based on sales and how much income was produced based on net income. Those are very different metrics. Sales does not tell us anything about the efficiency of running the business and having those sales generate actual income to the investors. Here is a price to sales ratio from Morningstar for Coca-Cola, and we can see how it changed over the period. Now, our numbers for 2020 are not going to be exactly the same because I don't know the exact date that Morningstar uses for its stock price here, but we can go back to our analysis sheet. And based on the numbers that we did pull, and it's okay if our numbers differ from Morningstar. What matters is when we're comparing different companies, we want to, in this analysis, as we will see on my analysis too, I'm going to be comparing Coke to Pepsi and Monster, and I'm also comparing it to the industry. It's really these, making sure that these numbers that I'm comparing are based on the same dates of stock price. So I have a price to sales ratio of 7.13, significantly higher than the industry median for Coca-Cola. And in my analysis, I wrote that for every dollar of sales revenue, investors are willing to pay $7.13 for a share of common stock. Coke's price to sales ratio is almost 3 times as high as the industry's. And so this might be an indication that Coca-Cola could perhaps, if my industry's median values that I pulled together are indicative of Coca-Cola's industry, it could mean that Coca-Cola is overvalued. Next metric we're going to look at is price to operating cash flow. This is where we take stock price and divide it by cash from operating activities on a per share basis. Remember, we need to take, where do we get the cash from operating activities? We're going to get that from the statement of cash flows. So I'm copying over my cash from operating activities and I'm inputting it here, and I'm going to get for Coca-Cola price to cash flow ratio of 23.93. Compare that to the industries of 12.62. And I said, for every dollar of operating cash flow, investors are willing to pay about $24 for a share of common stock. Coke's price to cash flow ratio is about twice as high as the industry's, so this may indicate that Coke's stock could be overvalued. Why use operating cash flow per share instead of the 2 metrics we just looked at, price per earnings and price per sales? It includes cash expenses. Remember, those were not included in the last metric we used, price to sales. Cash expenses are not subject to accrual accounting, but the downside to that is, well, one, operating cash flow can be negative where sales can't be, but cash expenses are not based on accrual accounting. So how could that be both good and bad? Depends on what you think about accrual accounting. Do you think that it's a better measure of performance for the company, or do you think that using cash rather than accrual accounting is a better metric of company performance? Here we see the data taken from Morningstar for price to cash flow. We see our numbers are similar, but not exactly the same as what we came up with. And it's just something, points to keep in mind. Price can be compared to estimated future operating cash flow. We're not going to use that in this class because we're not focused on estimating future amounts. And operating cash flow can be something besides operating cash flow. It can be free cash flow or some other derivation or deviation from operating cash flow, whatever the investor thinks is the proper metric to predict future cash flows. Our last metric is called the price to book ratio. We're looking at stock price to the book value per share. And remember, book value per share, if I haven't said it enough, total stockholders' equity, we can get that from the balance sheet divided by the number of common shares outstanding. It answers the question, how many times greater is the stock price than the stockholders' equity on a per share basis? For my price to book metric, I came up with Coca-Cola's stock price is 11 times greater than its book value per share. Compare that to the industry median of 3. And now we can do our full reveal of information. Coke stock is trading amount 11 times greater than its book value per share. This is almost 4 times greater than the industry's price to book, and this stock may be overvalued. Again, this is just a very rudimentary analysis. Please do not make any investing decisions based on this video, or do not hold me accountable if you do and it does not work out in your favor. The next analysis that I did was under this tab, Analysis 2. I followed the same procedure for Pepsi and then for Monster Beverage. These were both companies. I just skimmed through my data list of companies that I thought, there's only 160 something companies here. I said, which ones look like they might be somewhat comparable or might give us some data that is somewhat comparable? And collected this data off of the 10K. I went to Yahoo Finance, Google Finance to pull off closing stock price, calculated market cap. We can just copy over all of the formulas that we used here, paste them in for your other companies, and then a very, very quick analysis. Monster has the highest PE ratio, Pepsi has the lowest. We see the same thing for price to sales. We see the same thing for price to cash flow, so some consistencies giving us some information about relative values. For price to book, well, we saw that Pepsi has very little equity compared to, let's say, sales, compared to Coke. So we know that Pepsi is highly levered, so I'm not too surprised that Pepsi has the highest price to book ratio since it has lower stockholders' equity. Monster has the lowest. So overall, based on multiple of 4 metrics, which company seems to be the most overvalued? Monster. Which seems to be the most undervalued? Pepsi. Again, caveat, do not make any investing decisions based on this analysis. This is just trying to get you guys looking at financial statements and see one way that they're used for valuation. We've come to that time of this week's video for true and false. And for our first true and false question, I have a guest. Christopher, true or false? The PE ratio tells us about the number of times per week that a student has PE.
False. The PE ratio compares stock price to earnings per share.
Very good.
I thought PE ratio has to do with the number of times you eat.
Let's move on to some more serious true or false questions. True or false, the PE ratio is equal to stock price divided by stockholders' equity per share of common stock. Of course, that's false. PE ratio is price divided by earnings per share of common stock. True or false, a decrease in the price to sales ratio over time indicates that investors are paying less for a dollar of sales revenue. That is true. If it goes down, that means that investors are willing to pay less for a price of stock based on sales. True or false, the price to operating cash flow ratio compares an amount found on the balance sheet to an amount found on the statement of cash flows. False, stock price can't be found on the balance sheet or on the financial statements. We have to go with some market data source like Yahoo Finance or Google Finance. But cash from operating activities does come from the statement of cash flows. And finally, the price to sales ratio is typically, if not always, lower than the price to earnings ratio. And that, of course, is